This screencast is going to look at question 4, Herd PLC, from the question 5 question pack. So again, this is a fairly comprehensive question, and the first thing we're going to look at is, this is the slides around consolidated Splochy and statement of changes in equity. So I go through, and we've talked about this in class, is the 9 key steps in terms of how you might approach, and again, it's only a suggested approach. First one being read the requirements and the background information of the case. So again, we're really just looking here, what's the context, highlight any potential issue line items such as other income, and just getting a sense of what the company and the group is about. So hopefully you've had a chance to read down to the question and even attempt it. We'll just show how we approach this question now from completing it. So we'll have a look at the requirements first. So the requirements here: prepare the following for the Herd group. So we have 3 core financial statements, and then we also have a small little add-on piece in theory, which again you can look at in the solution. So we now know we have to watch out for the Splochy, SOFP and statement of changes in equity. So let's have a brief look at the financial information that's given, and also then just look at the background information before we look at the notes. So financial accountant Herd due to resolve a number of issues. So you acquired 3 million ordinary shares and 90% of the pref shares. That's important. So you might, whatever way you want to highlight that, but it's 3 million ordinary shares and 90% of the pref. So there may be a different percentage. And you paid €3.2 each for the shares, and preference shares were acquired at par. So straight away I get to the discipline of, well, how much does 3 million shares get me? And they're €1 shares. So I jump down and I realise 3 million over 5 million, that is 60%. Therefore it's a sub. So get in that discipline of figuring out, yeah, that's a sub, I'm okay with that, let's move on. And figuring out, would you also bought 90% of the pref shares. So if we go down here, well, you bought whatever 1.35 million pref shares. So you're just getting a sense there of linking that information. So draft financial statements, so that's okay. We're told about Herd and you've cattle, which is the sub, we know. So nothing unusual. Again, I'd highlight this line item. Other income, there's probably going to be a working there. There may be intergroup dividends. You'll know from past questions what to watch out for. That's one particular one. So that's okay. We've dividends here we need to watch for. So again, I might highlight them because I know dividends may have an issue, and you may label it statement of changes in equity or link it up here, so draw a line between these two just in case there's any intergroup dividends, which looks like there are. So coming down to the SOFP, well, we know there's an investment in cattle. That's okay. So can we rec where that 10950 comes from? So that's important, and it's useful at the outset. Can we figure out where that figure is coming from? Well, up here we said we spent 3 million at €3.20 each, and 90% of the 1.5 million. So a quick calculation will say 3 million times 3.2 is 96 plus 1350, which again is 90% of the pref, gets you 10950. So again, just make sure you're trying to reconcile the numbers and figure out, am I missing anything here? Is there anything else in there such as transaction fees? There isn't in this regard, so it's okay. So investment in guild, we'll have to watch for the notes to see what exactly that is. But then you look down along and there's nothing else really unusual that stands out. So again, we label it here, but really just getting the background of the case, figuring out what the numbers are. So the next step now, and again, do this before I go through it, have a look at the notes to the question, figure out any links, try and rec numbers to the table, and then look at key dates in the group structure, just in case there's any major acquisition. So if we go back to the question, we look up here, this was on the 1st of January, so again we're okay from a perspective of it's a current year acquisition and it's for the full year, so there's no pro rata allocation. So if we look at the notes, we say at the 1st of January, which was the date of acquisition, properties had a net book value of 2 million, had a fair value of 5. So straight away we know there's going to be a fair value adjustment, IFRS 3. And then we also know, given the information there, all we're really looking at here is there's going to be a depreciation adjustment. We can worry about the detail when we look at them. Really the initial point is just to get the lay of the land, what's actually involved in the question. So I'll just label here fair value adjustment. Next, for the year end, the current year end, Herd sold goods to cattle. So again, what label I put here is intergroup trading. NB, it is the parent to the sub, so that's important. So the parent to the sub, you're told how much they were, and you're told information about what was left in inventory at year end. So that's a standard unrealized profit inventory, and we'll watch about them when we come to them as we go through the notes. So you're told the sub, cattle's, preference shares, and non-redeemable. That's really just to tell you it's treated as equity. So if you look at the statement of financial position, you know IFRS 9, if it's non-redeemable, it's going to be equity. Therefore, it will go into your NCI calculation. Finally, Herd's investment in Guild comprised of 15% shareholding in Guild, which was acquired on the 1st of April. So during the year, at a cost of $850. And again, just make sure you can reconcile. Does that make sense? And it does. That $850, well, that's investment. And again, we know it's a 15% shareholding. Therefore, it's going to be a simple investment. So you don't have significant influence. Simple investment. And the fair value at 31st December is 1.2 million. So there is a fair value movement, and the directors want to incorporate this valuation. And dividends received from Guild have been presented on investment income also. So we know up here, this also includes some dividend from Guild, which again is legitimately there. So we've just to make sure, is there anything else in there? And there more likely is, read dividends. So that's our 4 elements. There's no real links between either of them. So we've kind of done this in terms of reviewed all the notes. We know there's now a subsidiary, cattle, and there's one simple investment, Guild. There's a couple of key dates in terms of the acquisition at the start of the period. And we also know we have some intergroup trading, and we also have a fair value adjustment. The next one I tell students that the step is just leave space. So you know there's going to be 3 financial statements. Leave about 4 pages so you can present a nice clean set of financial statements and reference to your appropriate working. So in here now we have, again, I've just set it up. First page I leave is a structure in terms of Splocky. So you know there's one sub, so I put in the parent. You can put in the sub. Now make sure you leave a couple of line items here in case there might be an associate, but you'll know from the reading the question whether you need to leave a line item or not. You might leave 2 columns in for adjustments, so we'll track them as we go down along, and then finally the group column. I always put in this yellow box to give you the discipline of a student to remember. Always think, is it a mid-year acquisition? If it was acquired on the 1st of July, you'd have to prorata the income statement that you bring in. But this is 12 over 12, so we're taking the same Splocky as is up here in terms of cattle and herd. So, and I just leave this line item then to be filled in as you go down now. So some people like to fill in at the start, or you can leave it blank and fill it at the end. Same statement of financial position. I've just filled it in for time purposes, but you can just leave it blank and fill it in at the end, but maybe leave 2 pages there because it's a bit long, typically statement of financial position. And finally 1 page for a statement of change in equity. You may not want to leave this at the end, or just leave an extra column or 2 in case some things appear as you go through the question. But leave those things. And now I might leave, some people like to do it, just a small half a page or a page to identify the group structure. So what I'll put in here is, for example, acquisition. So I might just put in acquisition, and we'll say here for cattle, I will say 3 million shares, and that will be, I'll just write down 60%, therefore subsidiary full year acquisition. So just that explicitly, and you'll get your mark from the examiner that you've shown 3 million shares, cattle is therefore subsidiary, and it was acquired for the full year. And I might also then put in Guild, 15%, so we don't know the number of shares, and it's a simple investment. So we've just shown the examiner, you know exactly what the structure is, and there's no debate then. You'll get your mark for identifying whether it's a sub, associate, investment, or joint arrangement. So along that step as well, then I open up my key T accounts. Now you may not want to do this, you may go a different approach, but I just want to show you this is essentially how I approach it. I'll open up some of the key accounts, so cost of control, retained earnings, pref shares, NCI, investment in cattle, and a few other T accounts, and all I'll do is populate the current balances as they are. So ordinary share capital has 2 balances of 20 million and 5 million, I just tot it in. Same with share premium, 3.5 and a million, just to set up the question. So then once that's set up, it takes about 30 seconds. You have a good base for once you go and do your adjustments. So that's all I do is set up. I might leave a page or two. Perhaps you might do it in landscape in terms of when you do on your exam script. There's no problem with that, just to get a bit more or a few more accounts on the page. I finally then just leave here is my appendix where I do all my journals. So that will cross-reference J1 right the way down to how many journals you need. Right. So that's essentially just setting up the structure. It should only take you a couple of minutes, but once you have that, you'll be very efficient then in terms of working through each of the workings and tracking the adjustments for the SOFP in a T account format. First step, always, I tell students, if you're following this account, is do up as much as the cost of control as you can. So the initial goodwill workings. So we know in our investment in cattle line item, i.e. here, we have an opening balance of 10,950. That is just brought to the cost of control account, 10,950, and that account is now gone. So it's cleared out, and we have in here investment 10,950. So that's the start, and you know, well, of that 10,950, what did Herd acquire? Well, they acquired a certain proportion of the ordinary share capital. They acquired a certain proportion of share premium and retained earnings, and a different proportion, that's important, of preference shares. So the portion they acquired of these three is different than this. So that's one trick to watch out for. So let's start with the ordinary share capital. So sum goes to cost of control, and in this instance, of the 5 million of the subsidiary of cattle, they acquired 60%. So ordinary share capital. So sometimes students want to do out journal entries. There's no real requirement because you're just doubling up your work. We know that always the approach is for cost of control is you're going to allocate the pre-acquisition equity. So you don't need to double up by doing a journal entry as well. You can if you wish, but it's sufficient just to do the journal entries in the T accounts. So that's 3 million. And we know then, well, the balance of that ordinary share capital of the sub at the date of acquisition must go to the NCI. So NCI gets 2 million, which is 40%. And again down here, the NCI will open up the NCI, because you wouldn't have anything at the start, of 2 million. So now we have our subsidiary ordinary share capital cleared out, and we'll just be left with 20. Same with share premium. So you have a cost of control. So again, pause this at any time now if you want to go back and review the steps and see is that consistent with how I might have done it. So share premium is 1 million times 60% and 1 million times 40%. So the benefit now of having a T account is all you have to do is slot them into the other account as you do it, and you'll never forget them. You'll always have to have in two places. So share premium, is 400. We may as well do our retained earnings while we're at it. Now the trick is here, you should not allocate, this is not the date of acquisition retained earnings. This is the retained earnings at the end of the year. If we look down here, or up here should I say, at the extract for the statement of change in equity, now you mightn't be given this, and you may have to work out, you may be just given dividends, you'd have to work out, well, add back dividends, take off profit for the year, and you realise opening retained earnings is 1985. So you may not always be given this, you may have to work back, so just be careful about that. And we see that in the Zumo question in class during the week, that you may have to work back to opening retained earnings. So we'll just put here, opening retained earnings equals 1985. So I'll just put that as a star, because what we're going to do then is, in terms of here, to bring to the cost of control, we will do 1985 times 0.6. So you're only going to bring your proportion of the opening retained earnings at the date of acquisition, 1191. And similarly, the NCI should get the other proportion of plus 1985 times 0.4. So you can see of the retained earnings, while we brought it all in, 3130, we're now clearing out anything to do with pre-acquisition, which is the sum of 1985. So now we've cleared that out of the retained earnings. We're bringing it into the NCI. So at the acquisition, the NCI also gets a share of, we'll just bring it over here, 794. So now we've post pre-acquisition retained earnings done, ordinary share capital done, share premium. The only one we need to do now is preference shares. And it's slightly different here in that it's no longer 60-40, so just be careful with that. It's now 90-10. So we bought 90% of the share capital and preference shares, therefore we should recognize 90% in the cost of control, and the final 150 goes to the NCI. Sorry, so that should be retained earnings, and this should be then pref shares of 150. Okay, so again, that you're always going to take them steps initially is setting up the cost of control account and recognizing the initial value of the NCI. The only thing you need to watch out for now is, before you do any finish of the goodwill account or to calculate goodwill, is watch out for any fair value adjustments, which we know we have, or if the NCI is measured at fair value. Now again, we're not told the NCI is measured at fair value in this case, so all we need to do now is go to our journal 1 and we need to deal with the fair value adjustment on acquisition. So we just put this up here. So we're told in the case, on the 1st of January, the date of acquisition, Cattle's property, which was a book value of 2 million, had a fair value of 5 million. So 3 million valuation adjustment. So let's take account of that. So debit property, plant and equipment 5 million, and credit cost of control and credit NCI. So all we're doing here is recognizing the initial fair value adjustment before we do the goodwill calc. So that gets 60% and the NCI gets 40%. So reference that journal 1. Sorry, it should be 5 million, that's 3 million. My mistake. Because the 5 million is the fair value, but the difference, the 3 million, is the fair value adjustment. So we take that then, journal 1, property, plant and equipment, we'll have our account open. So all you do is you get the opening balances, bring them in, and now we have journal 1, 3 million. It's nice and clean, and you're doing them as you go. So you don't have to come back to any working, you're capturing all the impact as you go. So credit cost of control, credit NCI. That's journal 1, 18.0, and finally then NCI, journal 1, 12.0. So now we know, having done all the question, we've all our workings done in terms of the initial acquisition. So we can now calculate what goodwill is to bring it forward. So 10950, we got all of these, our share of all the pre-acquisition retained earnings, plus our share of the fair value adjustment. So the balance must be goodwill. So it's 10950 minus the sum of above. So 3009, and then open up your goodwill account. 3009 is goodwill. So the cost of control never goes to financial statements. That's really just like a disposal account, a holding account to do the calculation. So you bring in the investment, you bring in all of these items, and then the balance then is what goes forward. So it's the balance that has its own goodwill account. I just do them separately to show them separately. You don't need to show a separate goodwill account. You can keep it all in the same account. So again, just for clarity, to make sure if anyone's confused, well, how might that look from a columnar method? Well, cost was 10950. And what did you get? Well, fair value net assets. Well, ordinary share capital, you share premium, you retain earnings, and then you had a pref, and then you had a fair value adjustment. So sorry, I'll just bring down the pref because that's a different percentage, so we keep that separate. So of the 10950, well, you got ordinary share capital was 3 million, isn't it? Let's check here. 5 million. Share premium was 1 million. Opening retained earnings was 1985, and we had to calculate that, or we had it in the question. And then the fair value adjustment was 3 million. So adding them up, that gets us to 10985, and don't forget then the pref was 1.5 million. So I keep the pref separate, because what you want to do is the split are different. So the total fair value and net assets was 12,485. You get 60% of these. Sorry. And you get 10% or 90%, should I say, of this. So while you get 60% of it, you only get 90%, and if you add them up, so what you got versus what you paid, your goodwill again comes to 3090. So based on that 3090, just bring this in a small bit. That's for our goodwill, and we come over here and we see our goodwill here is also 3009. So same calculation, just a different way of showing it. And to value our NCI then, well, the difference must be our NCI of here and here, which gives you a total of 4544. So our NCI based on 40% of this, which is the share, and 10% of this. And if we go to our T account, we see the exact same. If we add them up, the opening balance when we do our initial acquisition is 4544. So we're doing the exact same approach, just showing it two different ways. So that's the initial acquisition and the fair value adjustment. Now don't forget, we know we've highlighted depreciation is required as well. So it's only 1 year, so it's all going through the Splocky, and 50% is land. So why you're told that, you never depreciate land. So we're only depreciating, so we're going to debit retained earnings, which is essentially the Splocky, of 3 million times 0.5 times 2%. So 50% because half of it is land, so you only depreciate in the property, and 2% because it's 2% per annum and it's the full year. So that is debit retained earnings 30. So that is the retained earnings in the sub. So remember that, sub overall. So what we typically do is we don't do the sub, we'll split it out directly. So debit retained earnings 60% and debit NCI 40%. And then finally we credit our property, plant, equipment because it should be reduced by the 30. So again, this is, remember, in the subs account. So what I will do is, it's the full, and remember it's the full amount if it's in the subs accounts that will go to the Splocky, because the full amount is then allocated at the very end up here. Here is where the allocation happens. But for the SOFP, we need to allocate directly, hence we split it directly. So in terms of how I capture it, and again I make the point here, you need to make sure you have some labeling system for the Splocky to make sure you capture, well, one, does it go to the Splocky, and two, is it for the subsidiary? Because if it's for the subsidiary, then you need to be able to capture that for the allocation of NCI. So I put a star for the Splocky and it's capital S because it's also going to impact the subs profits. And we put the subsequent depreciation adjustment subs accounts, just to explain what that adjustment is for. So again, don't forget to actually put in the journal entries then. So here, J1 18. In terms of property, plant, equipment, it's J1 30. So again, stop this at any time just to make sure you're comfortable with it. And finally then J1 12. So 30 on the credit side, and then 12 on the debit side, and 18 on the debit side. And we also know that when we go to prepare our Splocky, that 30 needs to go in as an adjustment. So that's our first working done. Next working is, we know it's already intergroup trading and unrealized profit. So if we look here, Journal 2, Herd sold goods to cattle. So straight away the disciplined parent selling to sub. So we're told in this question, the goods originally cost Herd 390,000 and Herd achieves a gross profit margin of 25% on intergroup sales. All of these goods were sold to third parties except one item which is included in cattle's inventory at 20,000. Well, we always know there's a couple of elements here. One, remove revenue and cost of sales. The second thing is unrealized profit. And the third thing is there any intergroup balances at year end? So no mention of intergroup balances, so I think we know adjustment to make there. However, we do have to remove the revenue and cost of sales. So we know the total cost to Herd was 390, but they sold it on at a 25% margin. So this is tricky. You have to be very pedantic and watch the detail here. So the cost was 390. Now remember, if profit was 75%, or the margin was 25%, then cost is 75% of revenue. Therefore, revenue was this divided by 0.75, or you could divide by 75 multiplied by 100. So the actual price charged by Herd to cattle was 520, and you can just double check. Well, the profit they must have made was 130, and if you put 130 over 520, it's 25% gross profit margin. So again, that just, you try and work out. Sometimes you'll be given markup, sometimes you'll be given margin. Just be careful there. So we firstly know debit revenue and credit cost of sales for the intergroup trading of 520. So no impact on the statement of financial position because it's a net impact of nil, but you do need to just put a star that you need to remove them. So you don't need to worry about the sub here because you never worry about the subs profits for these. It's just the top line adjustment for revenue and cost of sales. So that's the first element, and the second element then is the unrealized profit. So you know you're told here all the goods were sold on, so there's no unrealized profit except for one item worth 20,000. And watch, it's included in cattle's inventory at 20,000. Therefore, it's already included, i.e., part of the 520. So what you're thinking is there, well, the unrealized profit here is 25%. This is how much cattle paid for it. Therefore, that includes a 25% margin. So unrealized profit, put it here, is 20,000 times 0.25. So it's 5,000. And remember, the unrealized profit is sitting in the parent's accounts because the parent made the sale. So all you have to do is debit retained earnings, credit inventory. You don't need to worry about the sub because it's sitting in the parent's accounts. So we'll just put 5 here. As again, we strip out the thousands. And don't forget then to put a star here because the retained earnings also goes to the splockie because the sales was during the period. So watch out for that. Do not forget to label the splockie as well. So this journal entry has to go in. Again, these can go in, but all you're doing is debiting retained earnings and crediting it. So the net impact is always going to be nil. So journal 2, debit retained earnings 5, and credit inventory. Again, all I'm doing is open up a T account. It's 1180 and 1450, and then journal 1, or 2 should I say, 5. Right. So that's our second element done. And again, the point is the majority of the marks will be going for your ability to figure out the workings and do the relevant journal entries. So we've now looked at a fair value adjustment and depreciation, and we've looked at intergroup trading, and we know that there's no balances. The final note that's here is to do with the simple investment. So what we need to do now is journal 3 is to deal with any issue in terms of the simple investment. So we know the simple investment is valued at 850 at cost in the financial statements at the year end, and we're told this fair valuation has now gone up to 1.2 million. So an increase in 350,000, and the directors of Herd would like to incorporate this valuation into the financial statements. Alright. So again, what we need to do first is recognize fair value movement. So it's simply a case of debiting the investment by 350,000. Like this. Debiting the investment 350, crediting retained earnings, because again that's where it's going to show up, of 350. So don't remember now, if you're crediting retained earnings, it's going to have to show on the splockie as well, and it's in the parent's accounts. So just put a star there to label it. That will show up in the splockie as well. So just go up, put our investment. So I have an account open, I think, investment guild, investments. I have 850, which is obviously the opening balance, and I go journal 3, 350, giving you that's the fair value movement. And then the retained earnings figure will also go journal 3, 350. So now I've captured exactly what the fair value movement is in terms of the investment in guild. And finally we're told dividends received from Guild have been included in investment income. So up here there's 481 in other income. However, we know some of that is more likely going to be due to pref and ordinary dividends paid by cattle as well. So we're going to have to do a journal 4 dealing with intra-group divs. So we know whatever dividend is paid by the simple investment is okay by Guild, because that is just debit bank, credit, other income. However, here any dividend paid by the sub, well, that shouldn't be recognised in income. So because it's paid, there's no SOFP impact. Right? So if it wasn't paid and was proposed, you may have to make adjustments as we looked at in prior slides or prior section in the course. However, when it is paid, all you need to do is adjust this blocky item. So you need to remove intra-group div. And in this context, the intra-group dividend will be, well, they paid 500 of ordinary dividends, so 500 times 0.6, and this is important for you to remember about pref div, and 90 times 0.9. So the total dividend attributable to intragroup dividends is 381. So put a star there. You need to remove that from other income. And again, the remaining 100 must be then from your simple investment, i.e. the dividends from Guild. So that's a tricky element in terms of you have to include both pref shares and ordinary shares in terms of the dividend paid and adjust according to their relevant percentages. So that's journal 4. No journal entry is really required, but just label it GA4 and you need to remove intragroup div of 381. So now we've essentially gone through all our steps. We've done the T accounts, we've opened the workings, and the final step that you have to make sure before you tot up the T accounts is make sure if you have an associate, bring in the post-acquisition share profits, or if you have an NCI, allocate the relevant share. So in this case, we need to allocate profits, post-acquisition profits, to the NCI. So journal 5, we need to debit retained earnings, and we need to credit NCI, post-ac share of profits. That's one step students always forget. So you have to figure out, well, let's look at the question. Cattle now have 3.13 million retained earnings at the end, and they started off with 1985. So based on that, the movement has been 3130 minus 1985 times their share, which is 40%. Right. So that gets you to 458, and you will then credit NCI 458. So the important point there is to remember is you're looking at the post-acquisition shares. So what did ordinary retained earnings move from the opening balance to the closing balance of 3.13 million, and they will get the share. Now note, any adjustments, so for example here, them adjustments will be captured already in the account, so you don't need to worry about them. You just look at the straight movement from opening balance to closing balance. And that's what we've done here. 458 is the post-acquisition share attributable to the NCI. So we've debit retained earnings, J5, 458, and then J5 here for the NCI, 458. So we've now captured that post-acquisition share. And again, there's no element here in terms of the Splocky, because we will show that on the Splocky ourselves, and that will be a separate working. So we'll say here, sep working for Splocky split. And I'll show you how that is done in a second when we get on to completing the Splocky. So we now have our step 6 done, and all we need to do is tot up the relevant T accounts. So relatively efficient, we've done all the workings, we've captured and we have aggregated them all already, so we don't have to worry about any columns or which goes to which column account to do all the workings. We've them all captured here. So we know our goodwill is 3009, so let's tot it in. So goodwill, in this case, is 3009. So property, plant and equipment, well, let's go down and see our T account. Over here, property, plant and equipment, we made 2 adjustments to it for fair value adjustment. and for a subsequent depreciation. So the SOFP will be 29561 minus the only credit entry, meaning the property, plant, equipment will be 29531. So we've all our T accounts done, and all we have to do is sub that in here, 29531. Investment in guild, well, we know that is from the question. We've one adjustment made, so it'll be SOFP will be 1.2 million. And again, that's consistent with what we got from the note 4 in the workings. So here we put in investment in guild, so just make this bigger. Investment in guild, 1.2 million. So next one to fill in, and again you may have this open and fill in as you go along, or you may wait till the end. Just make sure you leave enough space for any unusual line item that might appear as you go through the question. Inventories, our T account is here, with only one adjustment, so SOFP, the balancing figure, will be 2625. So add them together, minus your 5 for the unrealized profit. So that is 2625, and just add them up. Receivables, well, we didn't have any adjustment for receivables, so again there's no point opening up a T account, so you really only open them up as you go along. So in that case we're going to add together 3040 plus 750. 3040 plus 750, put obviously the equal sign, and I might just put here SOFP balance. To show the examiner there's no T account, it's just coming from the statement of financial position balances. Similarly with cash, we had no adjustments, therefore there was no reason to open a T account, so we just add 430 plus 290. Plus 30 plus 290. And again, we might just show it for the examiner, that is just coming from the SOFP balance. So now we have our total assets done, and we move on to equity and liabilities. Ordinary share capital, share premium, retained earnings. We all have T accounts there, so let's work them out. So ordinary share capital, we started off with 20 plus 5, and we removed the 5 because that was all to do with the sub. So the balance must be here, just the parent's share capital, which will always be, of 20 million. So put in here, ordinary share capital, 20 million. Share premium, the exact same. We started off with 4.5 million, but 1 million should be removed as it's to do with the NCI. So SOFP, 3.5 million, and the account is now balanced. 3599. Retained earnings is probably one of the biggest balances and the most difficult ones, and again where most of the marks are going for. So make sure you focus on that and get the adjustments correct and show the aggregation of it. We show the aggregation here. We started off with two balances, the opening ones, or the closing ones should I say, for the year end, and we made a number of adjustments for the initial acquisition and adjustments for NCI, etc. So the balance must be here, SOFP of 8640 minus some of the adjustments on the debit side, giving you 6174 to be the SOFP balance. So you might do plus all of these minus all of these in terms of a column adjustment, but you'll come to the same conclusion if you had all your initial journal entries correct. So that is 6174. And the final one then in terms of equity is your non-controlling interest, which we've done already. We knew it was initially worth 4544, and we had subsequent adjustments during the year. So the balance here, the SOFP, will be 5002 minus the 12. The balancing figure of 4990. So you can see once you have all the T accounts done, it's very quick to just tot them up and slot them in, and even if you do run out of time, if you've shown the right workings, you will minimize the amount of marks you lose because the examiner can see you've done the calcs correctly. Long-term loans, well, we didn't make any adjustments, so again very straightforward. It's 2 million plus 1 million. So 2 million plus 1 million, and again for the examiner's perspective, let's just put the title there, that's where it's coming from. So finally, we didn't have any workings to do with trade payables or taxation, so we just take the two figures here. So 1840 plus 121. And finally then for taxation it's 1020 plus 230. Oops, change that to here. And thankfully we balance, and again just for the examiner's perspective you'll tell them that, well, these are just added together from the SOFP balances. So that's essentially looking at your SOFP. Again, fairly straightforward once you capture them all, some way of aggregating the balances, and you don't have to worry about have you captured them all, because the double entry forces you to do that as you go along. So now we can move on to our Splocky, and again it's Splocky once you have the structure set up of having the sub, the appropriate Splocky for the, or the parent should I say, the appropriate Splocky depending on how many months you have for the sub. You then just, so this is the beauty of the labeling system, go down and pick out every single label for Splocky and just put it in. So you have here a negative 30 in operating expenses for depreciation, and remove the 520 from revenue and cost of sales. So we'll do those two first. So minus 520 from revenue and plus 520 to remove it from cost of sales. And also in OPEX we'll do a minus 30 for the extra depreciation that should be charged. And again, there's no real need to label these because you have to label it down here in terms of depreciation, or terms of the Splocky. In your cost of sale, we have unrealized profit of 5 that has to go in. So minus 5 in your cost of sales. And with any other adjustments, we've removed intergroup dividend of 381. And again, that should go into 381 up here. And we have the fair value movement, which you can put into other income, or I'm going to put it into OPEX to reduce OPEX. But if you wanted to show it separately, you'd be well entitled to do that. So I'm just going to put 350 here to reduce OPEX, and I put minus 381 here for intergroup dividends. As you can see, the Splocky is very straightforward as well if you follow this method, because you have them all labelled there, and all you have to do now is track them back. So here is the sum of these across, and you add up each of them across. So adjusting for cost of sales and unrealized profit, and here we'll add up these two. And we've only other income left of 100 because of course that's from guild, the rest was intergroup dividends. And we'll just work our way down along. No adjustment for tax or finance costs, getting to us a group profit for the year of 3550. So down as far as here is fairly straightforward. Using your labeling system, you capture all the items that are labelled from all your adjustments. Now when you come to the NCI, this is the tricky bit, and this is where the capital S is important. Down here there's one adjustment that when we go to allocate profit to the NCI, we don't use the 1735, we have to adjust it for any subsidiary profits made during the year, or adjustments should I say, and that is 30. So when we're allocating the NCI, so we'll just do it here, it'll be 1735 minus 30. Now there is another tricky element here, and this is always about watch preference shares. You need to minus the 90 out of here as well, and we'll see that in a second. And they take 40% of that, and then you add on the 90 and times 10%. So the point being here, so let's put in these percentage to make clear. The point is, if you didn't take off the 90, you'll be giving them the NCI 40%, but they're only entitled to 10% of that 90. So that is one trick in terms of the Splocky and preference shares that you need to watch out for. Because remember, preference dividends is going to be included in here, so you need to show that in terms of the split and how that's coming out. So doing that, so we'll do that calculation here. It's 1735 minus 30 for the adjustment, minus 90 times 10 or 40% plus 90 times 10%. So in that, the NCI is entitled to 655, and the balance of course must go towards the parent, which is 2895. Now one thing that I think it's useful to provide a reconciliation to our students to explain is, if we go down here to our workings, we only gave them the NCI 458 of payment for the post-acquisition profits. Yet when we went to our Splocky, how do we reconcile giving 458 credit in SOFP to a 655 share in Splocky? Because they're supposed to be telling the same thing. So that it's important just to see that already. And if we look in the T accounts, so what we had in the T account here is for NCI, so this is again, all these entries were to do with the initial acquisition. 4554, which again as we did over here, that's how we get there. So the only two adjustments we made in the accounts was 458 credit and debit 12 for the 30 adjustment for the unrealized profit. So in the T account, we credited 458 and we debited 12, giving net credit of 446. Okay, so that's the net position that we made in the SOFP. But what about the Splocky? Well, the Splocky, or the profit for the year, is 655, and of course that's a credit because that's going for the NCI. But remember, there's also dividends for the year, and the dividends for the year for the sub, which we need to put into the statement of changes in equity. Remember, the dividends show up in the statement of changes in equity. The sub are, and we go back to the question, 500 times 40% and 90 times 10%. So watch that. They're 40% of the ordinary div and 10% of the pref. So 500 times 0.4 plus 90 times 0.1. And that is a debit balance. Because remember, any dividends that come into the NCI are going to reduce the NCI. Right, so they're going to reduce that balance. So if we take plus 655 minus 209, again gets us to 446 credit. So it's the same net position overall. The profit for the year shows the gross, and then the statement of changes in equity shows the impact of dividend. So while they show both of them gross, the SOFP is the balance that shows it net. And that's what we use in our T accounts, is the net position 446. So that's how we get to the same answer. We now need to show our dividend coming out for the NCI of 209 in the statement of changes in equity. And that's where we're going to go to next. So we know all the closing balances from the statement of changes in equity are just the balances here on the equity portion of the statement of financial position. So in total 34664, which matches here. We know we had profit for the year, so let's just sub it in. This much was going to the parent in retained earnings, and this much 655 goes to the NCI. So here 2895, and here is 655. So that's our first element in. In terms of dividends, well, we can sub in as we required. Well, the dividends for the parent, which we're going to retained earnings, again we've just done already, is 750. So minus 750. And the dividend, some dividend shows to the NCI, only their portion. So we have 540 and 90 at 10%. So that is minus, and we have it down here already, calculated, 209. So while we show the net position of 446 in our T account, i.e. 458 minus 12, we show the gross position in the statement of changes in equity. Now we know, well, how is that going to get us back here? Well, actually we did make an acquisition, and watching Zumo as well, we talked about this before, that if you make an acquisition of an NCI during the period, that shows up also in the statement of changes in equity. And we recognized, again here, 4544, or you can do the sum of these. So we'll do here, equals the sum of all the initial balances we made in the NCI, which is all these 5 balances, which is 4544. And just summing these up to the tot. So when you add them together, you get 4990, and it equals the balance. So we know the NCI had nothing at the start, and that balances. So now we need to work on retained earnings. If we work through here, what is the opening balance in retained earnings as per the statement of changes in equity? So in that case, if we figure out, well, what could the opening balance be? If the closing balance was this and these were the movements, it suggests the opening balance was 6174 minus 2895 plus 750. Sorry, that's wrong. It's minus 750. So the opening balance was 4029, and if we add these three together, it gets us to the 6174. So is that correct? So once you've worked into it, you have to figure out, does that make sense? So we prove opening retained earnings. Well, the opening retained earnings in Herd, we were told in the question, was 4029. And we know, because we acquired during the year, this must be nil. We only acquired on 1 Jan. So it makes sense that the opening retained earnings of the group is 4029. We know we're correct. And that's what you have to watch for here, is watch out for any adjustments to opening retained earnings, but you may have to make an adjustment here. And finally then, there was no movements in these during the year, so the opening was 3500 and 20 million. So that's essentially the full question. You work on your SOFP first, using your T accounts or maybe your Collimer method. You use your labeling system to fill in here, and then the tricky element is, how much do you get for your NCI? But again, if you come back here when you're doing your statement change in equity and if it doesn't work out, you'll have to go back, you'll have made a mistake somewhere, because this should work back in terms of what your initial value was, and you add them together, it should equal the balance that's in your financial statements, or your SOFP. Similar approach to retained earnings. What is the profit you allocated for the year, less any dividends that might have been paid, in this case 750, and that will back you into what the opening retained earnings are. And it's up for the student then to prove that that retained earnings is correct, because if you don't figure out that, you may have made a mistake and you won't realize. We know that the opening retained earnings of the parent was 4029, and that must also be the opening retained earnings of the group, because we didn't have any subsidiary prior to the 1st of January 2010. Okay? So that is a full question in terms of SPLOCky, statement of financial position, and statement change in equity. So it's good practice, particularly using your 9-step approach or a variation of that depending on what you're more comfortable with. Alright, so that was question, the Herd question, question 4 on the question pack number 5.